We continue with our discussion on Unit 1 financial statements, and this section is going to start discussing about individual financial statements now. The first one that would come to our focus would be the balance sheet. Right now, this is probably the most important of all financial statements. And as a financial analyst, if you're going to build a career in financial analysis, then it is imperative that we understand the balance sheet in a complete and robust and comprehensive manner. So we'll start with the basics. I'm assuming a little bit of this would anyway be known to most of us, but regardless, we'll recap what a balance sheet stands for, what are the various items in a balance sheet, a generic balance sheet, and then we move on to the next set of financial statements as we go along. Right. So let's kind of understand the balance sheet and the concept of balance sheet. A balance sheet is a financial statement which gives an idea about the current financial position of the firm. We have seen that this is a snapshot of what the company owns and what it owes to various stakeholders, right? So it has probably taken money from someone. So if this is the company could have, taken money from someone, so it owes money to them, right? So it has taken money from a set of stakeholders, and then the company has used that money to own something. So it has used money to buy, let's say, some sort of assets, right? It is termed as a balance sheet since it represents an equality, right? What is the equality? Is that sources of funds any business has equals the uses of these funds for buying resources for the business. Remember, you've taken money from this set of people, that is sources of money. These are the people who have given you money, right? And these are the uses of money. You have used this money to buy all these assets. That essentially tells you an equality, that these two have to match, these two have to be equal. At any given point of time, a balance sheet cannot not match. It has to remain matched. After every transaction that the company does, the balance sheet has to match. And why is that? Is because the sources of money have to be equivalent to the uses of money at any given point of time, right? We'll understand this more as we go along. But let's first understand, why does it balance, right? Because the funds we raise and the applications of this fund will always match. Let's say if I borrow rupees 100 and buy an ice cream vending machine worth rupees 50 and have another 50 with me, what are the sources of funds? That's the rupees 100 borrowed by me. That's a loan. That's a source of fund. And that's also what is commonly known as a liability, because I have to repay it back. I have to give it back to someone who has given me the money. What are the applications of funds? I have taken 50 rupees worth of an ice cream vending machine, which is an asset, right? And I have the remaining 50 in cash, which is also an asset. I can use it elsewhere, right? There is no other way the distribution can work. It has to be essentially the sources of funds being equivalent to the application of funds. Typically, the sources of these funds, because people have given us this money and we are supposed to repay this money, this is also known as liabilities, or in other words, what we owe to people. The application of funds is essentially going to buy me some business generating assets, right? So it gives me some assets which typically will generate business for me, right? We'll look at what kind of assets come here. That's essentially what we own, right? So liabilities and assets, sources of funds and application of funds, or what we owe and what we own, are one and the same way of looking at the balance sheet, right? So we can rewrite this. We are saying what we owe versus what we own. This is what we are supposed to repay. This is what we have ownership on, essentially. This is our source of funds, and this is our application of those funds, correct? And in simple terms, Because we are supposed to repay it back, that's called the liability. And because we own this set of data, that's called the assets, right? That's the broad breakup of the balance sheet. Now you could choose to put it on the left, you could choose to put it on the right, you could choose to put it on the top or bottom. That's more technical in nature, but practically at any given point of time, both the sides should be equal. They cannot not be equal, right? So that's what we have to remember at any given point of time, right? Let's understand this and go ahead. So you have a business, you have a certain sources of funds. Where can money come from? Money can come from either equity holders or loans in the form of borrowing. How do you apply it? You can apply it in terms of buying business generating assets. What could those business generating assets be? Right? Let's try and understand this. So you could either get money in the form of equity, which is commonly an ownership, right? Someone owns the business or gets a stake in the business in the form of a percentage sharing of profits and losses that someone would get. And you could get in the form of what is commonly called as debt or a loan to the business, right? In terms of payment precedence, debt has a precedence of payment. So in terms when you're making the payments, the first priority in terms of priority of getting the payments is the debt holders, and then if something is left, it goes to the equity guys, right? So this will obviously become clearer as we go along. What do you do with the money that you have generated? These, remember, are your sources of funds. Once you have raised all these monies, you have to use them in application of funds. What can you do with it? You can buy raw material, you can buy factories, you can create a factory of it, you could buy equipment, machinery, and you could have the money remaining as cash as well, right? So you could have either of these sets of assets that you could have purchased with the money that you have. Either the money you purchase will give you some sort of assets in terms of raw material, equipment, factories, or it will keep lying in your bank account as cash. So that's why it has to match. You've taken about, let's say, 100 crore from here. It has to eventually go and get deployed in all these assets or stay as cash, right? So that's why it'll always balance. And that's what sources of funds and application of funds would typically mean. Now let's get one step deeper and try and understand what these individual segments are. We've already seen that the balance sheet is like a snapshot of the financial condition on a particular date. It will always be on a particular date. It's at a point of time. It is not a periodic statement, right? It shows the scenario and application of sources and applications of funds as on that date. The next day, the scenario might be different. The very next day, the scenario could change, right? So if we say balance sheet as on a particular date, in fact, in reality, it is also at a particular time. It'll be at 12 noon or 12 midnight, essentially. Every minute it could change practically. The balance sheet as on the next year, and you'd have done some business activity as we had seen earlier in going from point A to point B. That is what becomes, the movement of balance sheet from one year to another year. But it's always going to be a snapshot, as we had seen earlier, of the health of a business. Why the health of a business? Because it tells you what is that you own and what is it that you have to give back to someone at any given point of time, right? That's what a balance sheet would look like. That's what a snapshot would look like of the financial condition of a company at a particular date, at a particular point of time, right? Now, we've again seen sources of funds and application of funds. Sources of funds are also known as liabilities. Application of funds are also known as assets. Now, let's get deeper in terms of data points as to what these assets are and what these liabilities are. Let's look at the various kinds of assets. Now, you could have assets which are longer term in nature, which means Usually, they generate income for the firm over a period of time. When you say they generate over a period of time, they have the concept of what is known as a useful life, right? And usually long term would correspond to anything more than a year. That's what a long-term asset corresponds to essentially, right? One part of the long-term assets generically for most kind of firms is fixed assets because you need plant and machinery, etc. Long-term assets could also be in a sense divided into tangible versus intangible. Tangible would be your data like plants and machinery, so that's plant and machinery. Intangible could be things like licenses. Let's say a telecom company like Airtel has a license for 10 years. That's in a sense a long-term asset, but it's an intangible long-term assets, right? So these are assets which generate money for the firm over a period of time. Then you have another classification which is called as short-term assets, also known as current assets. Typically, the time period in which they will generate the revenue would be less than a year. They'll generate the money for you in less than a year. These would be sold in the near future or converted into cash in the near future. This money is going to come back into your firm in the near future. For example, inventory of raw materials or finished products. That's one part. So any inventory is one part. Second is you could have sold something. You have sold something, but you have not received the money. Sales which have not been realized, right? What are these? These are accounts receivable, also known as sundry debtors, right? Sundry means other, debtors mean the people who have bought something from us but not yet paid the money to us, but they're expected to pay typically in 2 months, 3 months or so. So they are classified as current assets. There are other current assets as well. We will take a look at those as we go along. But for simplicity purpose, the basic two current assets that we look at are inventory and accounts receivable, and these form the crux of what are going to be important parameters of how business is run, right? Then the third thing you could do with the money, it could be lying idle as either cash or cash equivalents. Now, what are cash equivalents? Cash equivalents are investments. Part of the funds which does not have an immediate use in the business, but may have at a later date. The company has passed on the same to another entity to generate some returns. This another entity could be a bank. You could keep your money in a bank. It could be a mutual fund where you are putting the money to generate some returns over a period of time. These are typically investments. Again, investments could be divided into two parts. They could be short-term investments or they could be long-term investments. Short-term investments are your bank deposits, etc. Long-term investments are typically investments in other businesses, right? So if you go and buy a 20% stake in another firm, right? Let's say Aditya Birla Group has gone and bought a stake in another firm. This is a long-term investment. This is a strategic investment. They're not looking to sell it immediately in the next 3 months, 6 months to get the money out again. They probably bought a coal mine or 20% in a coal mine so that they could ensure supplies to them at a period of time, right? That's the kind of assets we are looking at. Long-term, short-term, and investments are primarily the three broad classification of assets that we know of, right? What are the kind of liabilities? Now, either liabilities could come in the form of share capital, which is the initial amount of capital invested in the firm by the owners and promoters, right? First year, you put in some money, that's your share capital. Now, that year, if you made a profit of, let's say, 10 crore, but gave only out 1 crore as dividend, what is happening to the remaining 9 crore? That is the money of the shareholders, right? But it gets put back into the firm. It is reinvested in the firm. These will keep adding as sources of funds because it is the shareholder who has given this 9 crore again to the firm. They have to be returned to the shareholders at some stage. That's a part of reserves and surplus. Over a period of multiple years, Share capital and reserves and surplus combined, these two combined will form what is commonly known as equity of a company, right? That's the equity of a company. Then you could have loans that you have taken from banks or other entities which fall under this category. The loans could be classified in terms of long term and short term. There are other classifications as well. Long term is any loan that is more than 1 year. Short term is any loan that is less than 1 year. You have to repay it back in less than 1 year. That's a short term loan, right? Then similarly, most of these liabilities, your typically when you look at an equity or a debt kind of a liability, when you look at, let's say, an equity or debt, both of these are long-term liabilities in nature, right? Now, liability is something that you have to pay back. You could also have short-term or current liabilities. You have taken a short-term loan, that's a short-term liability. Purchases made by businesses but not paid for, right? That's like an IOU, IOU. That's called an IOU. This is what is commonly known as a payable. I have taken some supplies from my suppliers, but I have not yet paid money to them. That is what is commonly known as a payable. And essentially, this is a part of what is this is the most common form of current liabilities. Usually, I will pay or make the payment within a year. That is why it is essentially called a short-term or a current liability. There are again other current liabilities which are there in the system. We will discuss them as we go along, but primarily the focus of current liabilities sticks to payables in a company, right? Now, one more concept that is important for us to understand is the concept of depreciation. When we look at a business in general, the depreciation comes for any assets. This is effectively the gradual consumption of a long-term resource or asset. So if you buy a 10-year asset, an asset with a useful life of 10 years, this gradual consumption is kind of denoted by reducing the value or accounting value of the resource in each period, right? Now, there is a subtle difference between what is an asset and what is a cost. Asset versus cost or asset versus expense. Think about it. When you pay money, when a business raises money, this money could be used to buy multiple kind of things. This money could be given out as salary, this money could be given out as marketing expenditure, and this money could be used to buy a factory. Now, how do we know which one of these is an asset and which one of these is an expense, right? Now, expenses are essentially data points that, or parameters which you will consume in that year. If you'll consume that year, that's typically an expense, correct? So this is also kind of consumed the same year. Factory, on the other hand, is used over its useful life. So anything that has a useful life, a concept of a useful life, and you could use it over that period is what gets classified as an asset, an investment that is expected to generate income in the future, whereas costs are expenses incurred on products and services used up there and then, salaries and rent, right? The depreciation concept, because of the concept of useful life, applies only to assets, only to the assets, right? Let's try and understand. Let's say you buy a truck. You buy a truck, the value of the truck in the next year would be lower and lower and lower each year. If you effectively sell this truck after 1 year or after 2 years or after 3 years or after 4 years, the value would tell you that there has been a reduction in the value of the truck, and there has been a gradual consumption in a sense of the value that the truck gave you, right? Let's take an example. Let's say you purchased the truck in 2010 for 10 lakhs. Now we assume that the truck could be useful for 10 years, after which it would have to be replaced. So when you bought it in 2010 end, the value was 10 lakh. That's the current and starting value. Every year, because the data is for 10 years, now we're going to use what is commonly known as a straight line method of depreciation, which assumes that there are equal loss of value over over useful life, which means if the useful life is 10 and the value is 10 lakhs, you would take 10 lakhs and divide by 10. So every year you lose 1 lakh, right? So you lose 1 lakh, next year value is 9 lakh, then 8 lakh, then 7 lakh, then 6 lakh, then 5 lakh, and so on and so forth. And soon you will realize at the end of data that the value of the truck at 2020 is zero. Now this is a pure accounting treatment and need not show or indicate the actual sale of the truck in any year. Remember, if you sell the truck in 2013, you could get a different value. That's not necessarily what reality is, but you have to somehow account for what's going to happen with the value of the truck over this period. When it reaches zero, that effectively tells you that it's the time to replace or repurchase the asset. You need to buy it now, right? That's effectively what the concept of depreciation would tell you. So now remember that depreciation, however, is a notional expense, right? Actual outflow of cash took place in year one, but it is being accounted for over 10 years. So in the first year, when you bought the truck, there was a cash outflow of 10 lakhs. But in your accounting statements, in your P&L, profit and loss statement, you don't want to penalize by booking an expense of, so there are two ways you can do it, booking an expense of 10 lakhs in 1 year or expense of 1 lakh in 10 years. So in the P&L, this is what is used and this is what is not used, right? So you use booking of the expense of 1 lakh in 10 years because that's the useful life over which it will generate revenue for you. So it will generate sales, expenses, sales, expenses, sales, expenses over this period. And hence, it is important for us to kind of use the truck over a period in terms of accounting measures over its useful life. And that is what happens, that 1 lakh of notional expense, when I say notional expense, that's a non-cash expense. You're just showing it as an expense, but the cash outflow never happened at that point of time, right? 1 lakh of notional expense is what is available as the truck's value every year. We'll look at this in more detail as we go along, but just remember one thing, that when you add the assets value, in the balance sheet, you use the depreciated value. You use the current value of the truck, right? Let's take a look at a sample balance sheet. You would have assets and you would have liabilities. Assets would, let's say, I've just used a sample balance sheet that totals up to 1500 and 1500. In certain geographies, the left and right hand side may show liabilities and assets respectively. The above representation in horizontal. Some geographies may show balance sheet in a vertical format, assets and liabilities one below the other. Whichever comes higher, whichever comes lower, that's okay. That's not our botheration at this point of time. They'll always balance. And as an analyst, we need to understand the implication of these items one by one. Let's look at these items. So the first one that we see is depreciated value of long-term assets. Remember, we said the current value, which means if it has lost value, we have to use the current market or current fair value. It's not exactly the current market value, but it's the value that we perceive we will receive based on our depreciation assumptions, right? That's 800. Then investments are any investment done by the firm in financial instruments. You could also look at any investment done by the firm in other businesses. Those are all parts of investments. Then you have current assets, account receivable, money that customers owe us, that's account receivable, inventory, raw materials and finished goods in our store, and bank balances, that's money in our bank account. Correct? The money that we own or hold in our bank account is our bank balances or cash and bank balances. On the liability side, you have share capital, which is the initial capital infused by the shareholders. And reserves and surplus is profits retained and not distributed to or among shareholders. So essentially, this is what is the reinvestment over the years. This is, remember, a cumulative number. So every year, reserves and surplus adds to the previous year reserves and surplus, right? So if you had 2015 reserves and surplus plus 2015 profits minus 2015 dividends should give you 2016 reserves and surplus. Note what we are saying. We are saying reserves and surplus is the profit that the company has retained till date. It made another round of profit this year, correct? It paid out some part of that as dividend, so you subtract that, and that gives you the total amount of profit retained till 2016, correct? That's your reserves and surplus. That combined capital and gives you the reserves and surplus gives you the shareholder equity, or what is commonly referred to as book value of the firm, right? Or net worth of the firm. Then you have loans. Loans is straightforward. Any kind of long-term loans raised from the banks or other lenders. Then you have current liabilities where you have accounts payable, money we owe to our suppliers and others, and short-term loans. You could have raised loans to meet short-term funding requirements. That is what short-term loans would be, right? Combined all these and you get all your liabilities, which would be equal to all the assets that the business has. So that's basically a balance sheet and its view. Now, what is the significance of a balance sheet? As we close this section, a balance sheet, as discussed, is a statement of the financial position of the company on any particular date. For each balance sheet, the starting balance sheet is at the previous year end, and thus each balance sheet could be traced back to the origins of the business. You can just keep subtracting the P&L and cash flows from each of the years, and you could keep traversing back in time to get the previous balance sheets. Therefore, the balance sheet could have some assets purchased by the firm several years ago that would remain on the balance sheet until disposed of. Similarly, a liability would remain on the balance sheet until paid off. By comparing balance sheets over period, we can understand how the financial situation of the firm has evolved over the years. In contrast, if you look at the P&L statement or the cash flow statement, they give you data only for that year. But because a balance sheet retains the assets and liabilities from historical points, you could get an understanding about the business, how the business has run over the years, going back multiple years. If a firm took a lot of loan in 2010, you would still see it there and you'd realize there's something wrong that the company did there. The P&L and cash flow will only tell you what the company did in the last year, right? That's the significance of a balance sheet. When we look at live examples of the companies and we look at interlinkages of these statements, this will become clearer as we go along. The idea of this was purely to kind of do a quick recap of what the balance sheet is. Thank you.